Welcome to the deep dive. Today we're plunging into a topic that's, well, it's been everywhere. Bitcoin's recent, pretty dramatic price moves. And maybe more importantly, we're digging into why the experts are saying this wild ride might be about to get even wilder.
Yeah, that's the key phrase, larger price swings.
Exactly. They're anticipating larger price swings. So this isn't just about, what Bitcoin did last week. It's about understanding the hidden gears, the unseen forces driving the crypto market into what looks like, well, maybe a new phase of volatility.
Right.
So if you're looking to cut through the noise, understand the real dynamics shaping crypto's immediate future, you've definitely landed in the right spot.
And to guide us through this complex and pretty fascinating landscape, we've pulled together a solid stack of sources. We're looking at sharp market analyses, crucial insights from, prominent crypto traders and analysts, mostly from X, formerly Twitter, and detailed data reports. We've got significant input from places like CoinGlass, CoinInc, and Cointelegraph too. What's really valuable here, I think, is that these aren't just isolated guesses. They offer a multifaceted view of what's actually happening right now.
Multifaceted. Yeah, that's what we need.
We're getting technical views, on-chain data, insights into derivatives. It's a rich mix, really, designed to give us the clearest picture possible.
Perfect. So our mission today is crystal clear. We're going to decode the jargon, which can be intimidating, let's be honest, and pull out the most crucial bits of knowledge about Bitcoin's current state. We'll look at what the experts are forecasting, not just numbers, but the why behind it, the forces compelling these moves.
Exactly, the underlying mechanics.
Right. By the end of this deep dive, our goal is for you, our listener, to walk away feeling genuinely informed. Not just about what Bitcoin did, but what the key minds are saying it might do next, and crucially, why these bigger swings seem to be on the horizon.
Yeah.
So let's start unpacking this volatility.
Let's get right into it.
Okay, so kicking things off with Bitcoin's immediate past and present, it really felt like BTC just suddenly decided to, crank up the volatility heading into that recent weekly close.
It did, yeah. There was a definite shift.
We saw this incredibly dramatic surge, quite rapid actually, Bitcoin nearing, and then bang, surging above $119,000 on Sunday. Anyone watching the charts felt that tension build, and then, like a sudden release, it extended what was already a decent rebound.
What's really striking about that surge is the context, where it came from. This wasn't just some random move up. It was a pretty remarkable rebound from specific two-week lows.
Right, it had dipped quite a bit.
Yeah, it dipped significantly, down near that $114,500 level. And what makes this particular jump really noteworthy, as our sources point out, is that the market, well, it don't seem to have forgotten one of the largest ever BTC sales during this rebound.
Wait, forgotten? How does that even happen with something that big?
Well, forgotten is maybe a strong word, but think about it.
Right.
Typically, a sale of that size, millions, maybe hundreds of millions of dollars worth of Bitcoin hitting the market, you'd expect fear.
Right.
Downward pressure, or at least a long period of weakness.
Definitely.
But here, the market not only soaked it up, but just kept pushing higher with conviction.
That is wild.
Yeah.
So when you say forgotten, is it truly like market amnesia, or is there something else, like maybe massive underlying demand just absorbing it? It seems counterintuitive for Bitcoin.
That's a great question. It's probably less literal forgetting and more about overwhelming buying pressure at that specific moment. The demand simply outweighed the selling, even from a huge seller. It suggests a really strong underlying bid, maybe institutions stepping in or just a lot of capital waiting on the sidelines ready to jump in at certain prices.
Right.
Could also be an OTC deal, over the counter, arranged so it didn't hit the public market and cause panic.
And that makes more sense.
Whatever it was, the result was clear. A huge supply event that should have been a headwind just wasn't. It underscores either amazing demand or a weird liquidity situation right now. Shows resilience, maybe.
All right.
Or just selective focus on the bullish story. It definitely challenges the usual supply shock thinking.
Less amnesia, more appetite.
Ah,
Got it. And speaking of catalysts, it wasn't purely crypto stuff driving this, was it? Sources mention an external factor, something broader.
absolutely. That rebound also happened right as news broke that the U.S. and China had agreed to further delay putting new reciprocal trade tariffs on each other.
Okay, trade tariffs. How does that connect to Bitcoin? Seems worlds apart.
Well, yeah, at first glance, it does.
Yeah.
A geopolitical trade thing versus decentralized crypto. But think bigger picture. News like that, especially involving the U.S. and China, sends ripples through all asset classes. Maybe indirectly, but it happens.
Okay.
A delay in tariffs. Markets generally see that as less economic uncertainty. And uncertainty, well, it's poison for investment. It makes big players hesitate.
Right. Makes sense.
So when that uncertainty lifts, even temporarily, it encourages what they call a risk-on mood. Capital moves out of safer stuff, like bonds, and into riskier things with potentially higher growth.
And that includes crypto.
And that includes crypto. Even though Bitcoin often does its own thing, it's not totally immune to global sentiment, especially about economic stability. When traditional markets feel safer, like when trade tensions ease up, some of that confidence, some of that capital can spill over into riskier assets like Bitcoin.
So it's like a rising tide lifting even the crypto boats sometime.
Sort of, yeah. It shows how interconnected everything still is, even with crypto's independent streak. We saw that correlation, maybe subtly, but it was there. Crypto might be decentralized, but it lives in the global economy.
Okay, so we've got internal strength absorbing big sales, plus a little help from the macro environment reducing uncertainty. It definitely feels like it's setting the stage for what analysts are predicting next. That core phrase again, larger price swings.
Exactly. And it makes you ask, why now? Why are they predicting these bigger swings? The technical picture is key here. Sources highlight that BTC-USD was seen getting close to a key reclaim area.
A key reclaim area. Break that down for us.
Sure. Think of it as a price zone that used to be really important, either strong support where buyers stepped in or strong resistance where sellers took over, like a historical battleground on the chart.
Got it.
When Bitcoin gets back to one of these areas, it's basically trying to win back control, turn old resistance into new support, or vice versa. It's a high-stakes moment. Big players are trying to push it past that barrier.
Okay, makes sense.
And adding to that, Bitcoin was also trying to get a daily close above his 10-day simple moving average.
The 10-day SMA, right. Short-term trend indicator.
Exactly. For traders, closing above that average price of the last 10 days, that's usually seen as bullish. Short-term momentum shifting up, buying strength. Closing below it, bearish.
So attempting to reclaim a key zone and close above the short-term average.
Right. That combination definitely sets the stage for more volatility. These levels aren't just lines. They become intense fights between bulls and bears. Big orders get placed. Lots of money is spent trying to break through or defend these zones. It's a classic tug-of-war, and that tension builds up, priming the market for a decisive move.
A coiled spring ready to pop. Okay, so the million-dollar question, or maybe the $100,000 question for Bitcoin is, which way? Are the bulls winning, or are the bears sharpening their claws? Let's start with the optimists. Where do they see this going? What are the upside targets?
Okay, on the bullish side, we've got Ted Pillows, a well-known crypto investor. His analysis is pretty clear-cut. He says BTC needs to break above $119 on 5K for a big move.
$119,500. That's his line in the sand.
Pretty much. He sees that as the critical point. If Bitcoin breaks through and stays above that, it could signal a major acceleration. A powerful rally, maybe. It's likely a level with lots of shorts vulnerable, or where new buyers are waiting.
But what if it doesn't break that?
Well, that's his caveat. If it doesn't happen, he says, this consolidation will continue. And consolidation, as you know, is that sideways grind. Price stuck in a range, not really going anywhere fast.
Frustrating for traders, but sometimes necessary.
Exactly. It's the market catching its breath, figuring out the next direction. Pillows also adds a more speculative, but still bullish, prediction. He says, I think BTC could break above this level next month, which will start the next leg up.
So he's thinking longer-term bullish, maybe a new trend starting, but it might take a bit more time. Needs that $119 from 5K trigger first.
That seems to be his view, yeah. Patience might be needed, but the underlying path is up if that level breaks.
Okay, clear target from Ted Pillows. But he's not the only one watching these ranges, right? What about Rect Capital? He's another big name in analysis.
Indeed. Rect Capital, known for really detailed chart work and cycle analysis, he's looking at a similar range, but maybe slightly higher, just under the $120,000 mark. His focus is on Bitcoin managing to get a daily close above the blue range low, kickstarting a break back into the very briefly lost range.
Okay, let's unpack that. Range low, briefly lost range.
Right. So Rect Capital defines the specific trading ranges where Bitcoin tends to bounce around. Recently, price dipped below the bottom edge of its current range, what he calls the blue range low. That looked like a potential breakdown.
Bearish signal.
Potentially, yes. But then, crucially, it managed to achieve a daily close back above that level. That's the reclaim. It means the bears couldn't hold it down and the bulls pulled it back into safer territory.
Okay, so it reclaimed the range. What happens next, according to him?
That reclaim sets up what he calls a retest attempt to confirm the reclaim. This is super common in technical analysis. Once you win back a key level, the price often dips back down to touch it again.
Like testing the ice to make sure it holds?
Exactly. It's testing if that old resistance, or in this case, the lost support level, now actually acts as solid support. It's a moment of truth. So for rect capital, any dips into the range low, confluent with the new higher low, would be a retest attempt to confirm the reclaim. If Bitcoin pulls back to that range low, which also lines up with a new higher low, another bullish sign, and if it holds there, bounces off it, that really strengthens the bullish case for a move higher within that range.
It's the market saying, yep, we're serious. This level is solid now.
Precisely. That retest confirmation is a strong signal of conviction, turning weakness into strength.
Okay, so we have these optimistic targets, levels for breakouts, potential retests for confirmation, but it's Bitcoin. There's always another side to the coin. What about the cautionary voices, the potential pitfalls, the danger zones? Where could things go wrong?
Right. It's crucial to look at the other side. On the more cautious, maybe even bearish side, we have trader Cryptonovo. He gives a pretty stark warning. He points out that the price could still fill the daily downside wick left by the trip to $114,500.
Okay, fill the downside wick. What does that mean practically?
Imagine a price candle on a chart. The main body shows the open and close price. The thin lines, the wicks or shadows, show the extreme highs and lows reached during that day or period. A long wick pointing down means the price crashed low, but then bounced back up quickly before the day ended, leaving that tail.
Okay.
Cryptonovo's point is the market often revisits those extreme points. It might go back down to fully fill that area where it dipped rapidly. Maybe there's still selling pressure down there or unfilled orders.
Oh, a potential retest of the lows.
Exactly. And he gets very specific about where the danger lies. He identifies the main liquidation level is at $113.08K.
Liquidation level, we hear that a lot. Remind us what that means.
Yeah, it's critical in crypto because there's so much leverage trading, people borrowing money to make bigger bets. A liquidation level is a price point where, if the market hits it, those leveraged positions get automatically closed by the exchange to stop further losses.
Forced selling for longs, forced buying for shorts.
Exactly. And that forced selling, if longs are liquidated, can trigger a cascade. Price drops, hits more liquidation levels, forces more selling, price drops faster. It amplifies the move downwards dramatically.
Like dominoes falling.
Precisely. So Cryptonovo sees this downside liquidation cluster, basically a dense zone of these potential forced selling triggers, as a natural target in the midterm, $114.05K, $113.06K. He thinks the price might be drawn towards this zone.
So roughly $113,600 and $600 to $114,500 is a major danger zone to watch.
A very crucial zone. Hitting it could turn a minor dip into a really sharp, fast drop. A flash crash isn't out of the question if those levels are breached decisively. It's a potential magnet for price if things turn sour.
Wow. Okay, so those liquidation levels are potential flashpoints triggering chain reactions. That leads us perfectly into digging deeper beneath the surface. These forces aren't always obvious, but seem crucial for understanding why we might see these larger price swings. Let's start with this idea of max pain and what happens when shorts the bets on price going down get squeezed.
Right, this is where we really get into the derivatives market mechanics, which, like you said, heavily influence the spot price. Data from CoinGlass gives us a key insight here. They've pinpointed the max pain for BTC shorts at around $119,650.
Max pain? Sounds ominous. What is it?
It's a term from options and futures markets. It refers to the price point where the largest number of open contracts, in this case, short futures positions betting against Bitcoin, would experience the maximum financial loss.
Ah, okay. The price that hurts the most to bears.
Exactly. It's where the market could inflict the most damage on those bearish bets, potentially forcing them to give up and close their positions. It acts as a big psychological and financial hurdle for anyone shorting Bitcoin.
And the scale of money involved here.
It's huge. Sources suggest that if Bitcoin were to push back up towards its all-time highs, say near $123,000, the total short liquidations could exceed $1.1 billion.
Over $1 billion.
Wow. Yeah. Imagine that much forced buying hitting the market almost instantly. When shorts get liquidated, they have to buy Bitcoin back to close their position, no matter the price. This sudden, massive demand surge across many accounts can create a powerful upward spiral.
The short squeeze effect.
The classic short squeeze. One liquidation forces buying, pushes the price up, triggers more liquidations, forces more buying. It cascades upwards. That's why these liquidation zones are so critical. They act as fuel. amplifying moves.
And Coinint confirmed this kind of clustering.
They did. CoinInc, looking at their own liquidity data, stated there's strong resistance forming around 119,000, 120,000, indicated by dense liquidation clusters. Dense clusters. That tells you it's not just a few positions here and there. It's a heavy concentration of leveraged shorts, all vulnerable in that specific price band.
So 119K to 120K is not just resistance, it's a potential launch pad for a squeeze.
Exactly. It makes those levels incredibly volatile battlegrounds. They become magnets, either pulling the price up to trigger the squeeze or acting as a massive wall that, if broken, ignites an explosive move.
Okay, the liquidation dynamics are clearer now. Huge amounts of money creating these potential acceleration points. But you mentioned something even deeper, more complex. Gamma exposure and dealer behavior. This sounds like the really hidden stuff influencing those larger price swings.
It really is. This is often the unseen hand, quietly but powerfully shaping volatility. Analyst the Kingfisher warned about heightened volatility based on seeing predominantly red on the BTC GEX Plus chart. Now, GEX Plus refers to gamma exposure.
Gamma. Okay, this sounds technical.
It is a bit, but let's simplify. Gamma, in options trading, measures how sensitive an options delta is to price changes in Bitcoin itself. And delta measures how much the options price moves for every $1 change in Bitcoin. Don't worry too much about the definitions.
Okay.
The key is what it means for the dealers or market makers. These guys provide liquidity. They're constantly buying and selling options and futures. Their goal is usually to be delta neutral balanced, so small price moves don't kill their profit.
All right, they want to manage risk.
Exactly. But when they are short gamma, which happens often when they sell options to us retail folks or institutions, their hedging becomes super sensitive to price moves. And this is the crucial part. When dealers are heavily short gamma, like that red on the GX Plus chart suggests, it means that as Bitcoin's price moves, they are forced to actively buy or sell Bitcoin itself to stay delta neutral, to manage their risk.
Forced to buy or sell. How does that amplify things?
Think of it like this. In a short gamma situation, to manage their risk, they essentially have to trade with the market's momentum. If Bitcoin starts rising fast, maybe retail buying, maybe short liquidations starting fast, these dealers are forced to buy more Bitcoin to rebalance their books.
So their buying adds to the buying pressure.
Precisely. It pushes the price up even faster. And conversely, if the price starts dropping, they're forced to sell Bitcoin to hedge, which accelerates the drop.
Wow. So they're not trying to cause volatility, but their risk management creates it.
Exactly. They're just trying to stay hedged, stay neutral. But the way they have to do it in a short gamma environment inadvertently pours gasoline on whatever trend is starting.
Right.
It becomes a self-reinforcing cycle.
That's incredible. The structure itself generates the swings.
Right. And this directly feeds into that prediction of larger price swings in the near term. It's a consequence of these market mechanics.
Yeah.
The Kingfisher's advice. Monitor these shifts closely. They're powerful, often hidden signs of incoming volatility.
Yeah.
That's the unseen hand pushing the swings.
That is. Yeah, that's a profound insight. It's not just random market noise. It's being actively amplified by the professionals just trying to do their job safely. Changes how you think about big moves. Okay, let's try and bring this all together. For you, our listener, trying to stay informed amid all this complexity, what does it all mean? What's the takeaway as you navigate this?
I think the main takeaway is that we're at a really critical point for Bitcoin. We've got these conflicting signals, but they actually complement each other. You have the bullish targets, Ted Pillow's $119 5K breakout, Rect Capital's range reclaim under 120K, suggesting potential for big moves up. But then you have the stark reality of the downside, like Cryptonovo's warning about that $114 5K to $113 6K liquidation zone, which could trigger rapid drops. The market isn't just drifting. It feels poised, coiled, ready for a significant move, potentially in either direction.
So understanding both sides is key. Don't get tunnel vision.
Absolutely. You need that balanced view to anticipate scenarios, not just react when they happen.
So if you're watching the charts, following the news, what are the most important actionable things to keep an eye on based on everything we've discussed? The key indicators.
Okay, boiling it down from the sources, here are the absolute key levels to monitor. First, that $119 5K breakout level from Ted Pillow's. That's your main upside trigger for a potentially big move. Watch for a clear break and hold above it.
Got it. $119 5K said.
Second, that whole $119,000 to $120,000 zone. CoinInc flagged it as strong resistance due to those dense liquidation clusters, and it ties into Rect Capital's range stop. Breaking above this decisively, that could be explosive, maybe triggering that huge wave of short liquidations.
Okay, the 119K, 120K resistance liquidation zone.
Third, on the downside, you absolutely have to watch that $114.05K down to $113.06K cluster identified by Cryptonovo. If selling pressure builds, this is seen as a natural target. Hitting this could accelerate drops fast because of forced selling.
The downside danger zone, $114.05K, 113.06K.
And finally, remember that max pain level for shorts, around $119,650 from CoinGlass. Price might be drawn to it, or moving above it could really squeeze the shorts and fuel a rally.
Max pain near $119,650. Okay. Those are clear battlegrounds.
They really are. They're not just lines. They're zones where huge amounts of money and forced actions are concentrated. Watching them gives you a critical edge.
And beyond just the numbers, this whole discussion really underscores how vital it is to understand the forces behind the numbers, right? The market psychology, the hidden players, the mechanics driving the moves.
Exactly. It's about seeing the bigger picture. Knowing, for example, how dealers hedging their short gamma risk can actually create volatility that gives you a much richer understanding than just looking at a price candle. You realize volatility isn't always random. Sometimes it's baked into the system.
Right.
And understanding liquidations, how they cluster at specific levels and cause those rapid cascading moves, changes how you interpret sudden drops or surges. It's not just panic selling. It's often mechanical forced selling.
Mm-hmm.
Plus, seeing how even external things like trade tariffs can ripple through, reminding us crypto doesn't exist in a vacuum. And recognizing that ongoing fight between bulls pushing rebounds and the market needing phases of consolidation, it all paints a much more complete dynamic picture.
So putting it all together, how should we prepare for what seems like an inevitable period of these larger price swings?
Well, the expectation itself is preparation. Knowing that these larger price swings aren't just a guess, but a likely consequence of all these dynamics we've talked about, the liquidations, the dealer hedging, the key levels being tested, that's powerful.
Yeah, knowledge is power here.
It really is. It helps you interpret events with more clarity. When you see a sudden move, you can ask, is it hitting a liquidation zone? Is gamma hedging kicking in? Is a macro event playing a role? It shifts you from just reacting to actually anticipating and understanding.
Yeah.
Recognizing those invisible levers helps you navigate the volatility much better.
And that's really the goal of the deep dive, isn't it? To move beyond headlines, get that deeper grasp. And speaking of which, before we wrap up, if you found this discussion valuable today, please do consider subscribing, maybe leave a comment, or hit that like button. Your engagement genuinely helps support the channel, helps us get seen in the algorithm, and honestly, it lets us keep making quality crypto content like this for you. We really appreciate it. So as we close out this deep dive into Bitcoin's choppy waters, let's leave you with a final thought to chew on. Given this really complex dance between charts, sentiment, and those hidden dealer strategies amplifying swings, how can you, as an individual navigating this space, build a truly resilient mindset?
That's a great question.
What mental tools or strategies become most valuable when volatility isn't just likely, but actively amplified by the market's own structure? It goes beyond just predicting, doesn't it? It's about cultivating the adaptability and insight to handle those larger price swings when they arrive. Something to think about.
Indeed. What tools help when volatility is structurally amplified? A really crucial question for everyone involved.
That's it for the deep dive today. Thank you so much for joining us on this exploration. We'll be back soon with another deep dive into the crypto topics that matter most. Until then, stay informed and stay curious.